Individuals tend to focus on having enough money saved at the time they retire. But it is important to understand that once withdrawals begin, the impact of market declines to that nest egg is significantly amplified.
People who are reinvesting their dividends and capital gains and even adding to their accounts, they can afford the dips. Like 1987, where the market went down 20% and came back, that doesn't bother retirees. But years like 2001 and 02, where the market goes down 3 years in a row, and you need to take out money each year, then you're dropping your value of your account much lower than the actual market. So when the market does rebound, you don't have enough. The second thing that happens is retirees are much more vulnerable to emotional whims. They get a little bit more nervous. So when the markets go down, they tend to pull their money because that's all they have. And that's usually the wrong move.
And how does timing play into your strategy?
Well, it's the sequence of the events that really dictate how well or poorly most retirees perform. Naturally, those with lots of money, they can put their money in CDs or bonds and just live off the interest. Most people are not like that. So if the sequence of the returns are you retire in 1999 and you have a 3-year decline, you're in trouble. If you retire in 2003 and then you have 5 straight years of the markets going up, well, then you're in better shape. But that's the time to start taking money off the table and get more conservative. So the answer is have a plan. Know when you're ahead of your estimates. Know when you're behind. And the way to do that, in our opinion, is figure out the rate of return that you need. Once you figure out the rate of return, then you have a benchmark. Not the S&P 500, not the Barclays bond index. What's your rate? Once you can calculate your rate, which can be done, then you know when to be a little bit more aggressive, when to be a little bit more conservative, but not go too far from your allocation that's necessary. Not get greedy.
What's the best way to figure out what rate of return is good for you or that you need?
It's very un-American to do a budget. People just don't want to do budgets. You have to bite the bullet. Be an adult. You're about to be retired. Do your budget. Figure out what you really need. It makes you more business-like in your approach to your finances. It's got to be that. It's got to be more business, less emotional.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to